Hey, everybody, I'm going to vent in a very constructive way. This is information that every investor should understand out there and know out there. So, I have three things that really frustrate me about the industry that I'm in, the financial advisory industry. So, I want to start with the fees and the disclosure of fees and the transparency of fees. It bothers me quite a bit. So, understand knowing the licensing that your advisor has will help you understand how and where they're allowed to charge fees. And so the 65 is an independent license. It's considered fee only. They're only allowed to charge you a fee for the advice that they're giving. And that's that simple. They can't hide the commissions and other stuff that's going on in there in the stock market world. That's the important distinction, because the insurance licensing is different. That commission is not coming from your money. And so normally it doesn't really get disclosed. It's a different type of commission, but the commissions in the stock world, they do come from your money. And so you have to understand the difference. So when there's a 7 and 6, they're not only allowed to take just those management fees, they can take all different types of fees. It doesn't mean that that license is bad. It just means that you have to understand that they can take the fees from anywhere and everywhere. And so when we see this type of a situation, we see lots of miscellaneous fees. This is the problem in the industry. There are disclosed fees, but there are also these hidden fees that are hidden in 13 pages of disclosures that you'll never see on your statements. And so we have to be careful about this. We've seen fees pop up like account setup fees, termination fees, transfer fees, the mutual fund fees that I'm going to go through on the next slide. That's one of the biggest abuses. And every once in a while, the industry shakes it up and says, we got to get rid of these. And they just come this close to trying to get rid of them. And then let's forget it. Let's move on. We're not going to get rid of them. And so these mutual fund fees are extremely hidden. And I'll show you the difference on those things. Redemption fees, annual maintenance fees. I actually saw an advertising fee taken out of somebody's account. They listed it on their statement. It was hidden in, a 123-page statement, but it was taken out of their account. I couldn't believe it. Annual account fees, operating expenses, transaction fees. These are all fees that I've seen taken out of people's accounts. So you've got to be careful about this stuff. We should have clear disclosure of fees. This doesn't seem to be fair, because it's certainly not an even playing field for someone who's 65 licensed versus somebody who's 7 licensed. And understand the difference. 65 is for an independent advisor who doesn't have an employer telling him what he has to do. The 7 and 6 has to have an employer looking over them, telling them what they have to do and all these fees that they have to charge. So it's a little crazy out there, the stuff that we see. Certainly the 6 and 7 has a lot more ways to make income per se. Now, that doesn't mean that they do, but they're allowed to. All right. So mutual fund fees. This is the worst of the worst, in my opinion. These Series 7 and 6 licensed people can take commissions from mutual funds. This money comes from your dollars and is never disclosed to you on your statement. Now, if you read all the pages of the fine print, there may be some general disclosures that they may accept some forms of commissions, and you might find some of that in there, but the reality is this goes unseen in our industry, and it is terrible as far as I'm concerned. So understand, every mutual fund out there has multiple different shares. There's an A share, B share, I share. There's lots of different shares. There's share 1, 2, 3. The mutual funds are getting smarter. They're starting to, instead of using ABC, they use Roman numerals, or they use XYZ instead of ABC. They're all starting to change it up to make sure people can't follow along to figure out which are the bad ones, right? So every mutual fund has multiple different versions of that mutual fund. It's the exact same mutual fund. The only difference is the fee structure. So in my example here, again, I'm trying to protect the company because every mutual fund has this. It's not any distinct company doing this. It's every company that does this. They offer the same mutual fund in many different fee structures. So in this case, this is just a Dow Jones fund, 2030. So one of those target date funds. So here, A share. What a front load is when your money goes in there, the advisor is allowed to take 5.75% of your money and put it in their pocket. And the worst thing is most of those advisors say, oh, I didn't do it. That was the mutual fund company. But the mutual fund company pulls it out and hands it to the advisor, technically. And then there's an ongoing expense of 1.06. So if the advisor has a management fee, maybe that's 1%, and they're using a mutual fund with 1% in fees, that's 2% in fees coming out of your account annually. Okay, that's constantly, forever. Whereas this front load is a one-time commission when the money goes in. So that's why they end up having quarterly meetings with you and rebalancing and moving stuff around because they're going to pull it out. They already made their commission there. So now they're going to put it over here and make another commission and take another 5% of your money. Okay. The B shares are usually even worse. So now this one has a 5% backload, but look at that annual expense. And not only is the annual expense a lot more, but then they're taking some of that money and handing it back to the advisor. So now the advisor, these are the ones that used to say, oh, I don't charge a fee. Oh, they are. Because they're making a big commission when that gets sold. Again, another incentive to have you come in every quarter. We got to adjust. We got to move stuff around. It's like the investing world only works quarterly. But I think we know it doesn't, right? So we've got to know that there's all these different shares because 0.75% in fees of that 1.77 is going back to that advisor, and that advisor is getting paid every time they sell that mutual fund for rebalancing purposes usually. Okay, so understand that same mutual fund is out there available in an iShare. There's zero load, no commission, no money comes out of your account and pays that advisor or mutual fund. The ongoing expense, the annual expense is only 0.51%. Now, if the advisor is charging a 1% management fee and the investments cost you about 0.5%, now you only have a 1.5% coming out of there. Not as bad, right? Certainly nowhere near as bad as the A or B shares. So again, please be careful about this stuff. Understand that every mutual fund has a different fee structure. Point blank, ask, are they taking those front loads or back loads from those mutual funds? Are they getting a 12B1 fee? Boy, you say that and the advisor goes, oh no, I don't know how to answer that. I've heard stories about the stammering and they just knew something was wrong when they asked that question. And that's why they're in my office talking to me or talking to me over Zoom. So please understand that these fee games are out there and they're still going on nonstop. All right. So the second thing that bothers me, the industry's use of bonds. Look, investing changes. Economic conditions make investing change. We have to understand bonds are not stocks. Okay. As interest rates rise, the value of a bond goes down. Okay. Which means as interest rates go down, the value of a bond goes up. Well, what have we been doing for 30 years? 40 years. 1982, that's, oh man, that's painful. That's 40 years ago. I think I'm getting old. 40 years we've been watching interest rates go down and down and down and down. And notice, we try to push them up and they fall further down. And we try to push them up and they fall further down. We try to push them up, they fall further down. Push them up, down, push them up, down, push them up, down. And there we are. Really, most people say after that 2008 crash, that was kind of when we hit the rock bottom of interest rates. Some people say, well, it's after 9/11. Well, in perspective, 9/11, we never thought interest rates would go any lower than that. But holy cow, did they really? Again, we tried to push them up, then 2008 happened. We tried to push them up, then we fell apart again. We tried to push them up and fell apart. Tried to push them up, they fell apart. And now here we are pushing them back up. Now we're at those interest rates back when we pushed them up after 9/11. Things started breaking. Feds came out and said, hey, we're going to hold off. Maybe we'll lower some of those interest rates. Because every time we push up, we start breaking things. And usually that's followed by some form of a market correction. And boom, they slam those interest rates back down. So why am I talking about interest rates when I talked about bonds? Well, bonds. As interest rates rise, the value of bonds go down. So for those of you paying attention in 2022-ish, you had a really rough year in all of your bonds. And I got news for you. It's been going on a lot longer than that. Look at this, 5 years, 5 years, total bond return, 5-year annualized 0.46, 10 years, only 1.41. Your bond portfolio, and this is, you can look at any of your bond funds and look at the 5, 10, 15-year performance. You're going to look at it and go, oh man, what have I been doing all these years? Because it's all mixed into your whole portfolio, and your stocks did well, so you didn't really notice your bonds have done nothing for 20-ish years. An annualized return of only 2.48 over 15 years. Why are we using these bonds? It's so obvious. When interest rates hit nothing, you get out of bonds. Because as interest rates rise, or if we just flounder sideways, you're going to continue earning nothing. And every time we see inflation, here's the problem. In order to combat inflation, what do? We rise interest rates. Well, that's what we did in 22. We were combating inflation. Our economists believe that raising interest rates will help squash that inflation. Whether it works or not, that's another argument. But the reality is that's what they're going to do every time we see inflation. So if you're a retiree using bonds as a safe investment, every time we see inflation, you're going to lose money. So why on earth are we still using bonds as a blanket safe investment in our portfolio? If anything, you can use it in a little bit for speculative growth because you think interest rates are going to come back down. I'm okay with that type of use, but don't tell me you're using it as your only safe investment, because that makes absolutely no sense. If our interest rates were back up at 10%, I'm all for it. Put all your money back into bonds after we go way up there. But perspective, please keep your perspective. We're only at 4.25% on the 10-year right at this moment. It's going to change, but right at this moment, we're only at 4.25 on the 10-year. We got to understand that we're really still very low in interest rates. And every time we try to push up, we come back down, push up, down. So we're probably just going to flounder sideways is really what we're going to do. Because if we go more than what we've been doing, more stuff is going to break. So why does the industry keep doing this? Well, honestly, that's how most of these big companies make their money. They're the ones being the market maker behind the scenes, buying and selling. So they're buying for 80 cents on the dollar because they can go buy $1 trillion worth of bonds all at once, and then break it all into little parts and sell them to you for 105 cents on the dollar. And you didn't know they just made a whole bunch of money. Or the bond funds that are in your general investments. Well, they're charging their management fees on there, and the mutual funds have their fees on top of that. There's so many reasons that their fee structure and how these entities all make money, that's how they make their money, and that's it. That's why they still hang on to these things. There's so many alternatives out there for safe investments, but we've had an industry that's just is so hooked on these bonds for so long for good reasons. They performed very well in the 90s and even the 80s. They performed very well. Then you get into the early 2000s, you still had portfolios that had those older bonds that had much higher rates. They were still doing okay. But once you get into the 2010s, holy cow, bonds have just been horrific. They're terrible. And it was so obvious. So why does the industry do this? I don't know. I don't get it. Your business makes money off of them. Okay, that's the only reason. So the third and last one that really frustrates me is this whole concept of no, I can't talk about taxes. Advisors, licensed securities advisors, anybody in this financially advisor industry has a hard time working and talking around taxes. It's taught in the CFP. How can we not talk about taxes? Well, it's because we have lawyers telling us we're not allowed to. That's why. We're a litigious society. It has nothing to do with the licensing. I own a tax firm. I can talk about taxes, but they still don't want me being very specific, like holding up your tax return saying, well, you should have changed this number to this number. And I can't get that specific, but I have to be able to talk about so many different things that have to do with taxation. Because think about every financial advisor out there and anybody that's building a portfolio, picking investments, doing their job. Think about this. Every investment choice in your after-tax savings, not in your IRA, not in your Roth, but in your after-tax savings comes with different tax consequences. I do a tax class all the time, and I'm sure I got plenty of videos on here about taxation, but please think about that. If I buy a municipal bond, it's tax-free. If I buy a qualified dividend-paying stock, it's going to be taxed at lower rates. But if I buy a mutual fund, I can't control what that mutual fund is going to buy and sell, and then you're going to get taxed higher rates. Well, everything I do in your after-tax portfolio taxes you differently. So I have to understand those differences. Roth conversions, how much, when, why? That's all about taxation. It's all about taxation. I have to be able to talk about things like this. I have to be able to advise you on things like this. Sources of income, when income planning, when I talk about income planning and actually putting together an income for somebody, being as efficient as I can, a whole lot of taxation has to do with that. If your income's over a certain level, you're going to start paying a higher tax rate. So then I need to start looking at tax, a bit more tax efficient, lower taxation, like bond portfolio. Maybe I'll use a municipal bond, or maybe we'll go to qualified dividends because they're tax advantaged. But that's when we hit a certain income level, and that has to do with taxation. Okay, when to use a municipal bond versus a corporate bond? Well, I got news for you. Municipal bonds in little bits here and there are very useful for some people, but it's always about taxation. People in lower tax brackets, municipal bonds usually don't make any sense whatsoever. Depositing into a 401k, the traditional pre-tax 401k or Roth. How am I supposed to answer that question? If somebody comes to me and says, should I be putting into my traditional 401k or my Roth 401k? How am I supposed to answer that question if I can't talk about taxation? It's absolute ridiculousness. So taxation of Social Security because of portfolio decisions happens out there quite often. People that aren't paying attention to taxation are causing you double taxation, more taxation that shouldn't be happening. So taxation has to be talked about. And the key for advisors is talking more in generalities, talking relevant to the investing side of this, not here's how we do this on a tax return, and here's what you should do here, and here's what, no, in general, educationally, we can always talk about that. We can advise on what's right for you based on your situation, but we should not be talking about the very, very specifics, giving you very specific tax advice on specific things. So just understand that the people that work for big employers, those employers are responsible for them. And if they give bad advice, the employer has to pay the penalty, right? Whereas an independent advisor, they're responsible for everything they say. So they're going to be more knowledgeable, or they're just going to be completely negligent and they're going to get hurt sooner or later. So we have to look at this logically, and we have to be more careful about this. We have to be able to talk about taxation without the worries of lawyers suing us constantly and causing problems. It has to be relevant to the situation. It has to be general understanding, but here's my advice for your portfolio. All right, that's the difference. All right, I hope that helps. It's me ranting because these are three things that just absolutely drive me bonkers in this world. So let us know if we can help out. We're always happy to help. Yourinvestmentcounselor.com. You can always set an appointment with me. There's 30-minute meet and greets. There's hourly appointments. I'm happy to help out in any way, shape, or form. Give us a call. Also, if you're looking for a full education, February is when I did taxation. Next month, March, is going to be Roth. We're going to do classes every single month, full form, hour-ish type long classes. We do them live over Zoom. So go on to fpfeaz.org and find our full schedule, and you'll be able to sign up and get on any of our live classes. All right, everybody. Thanks for bearing with me, letting me vent, and I hope you enjoyed that, and we'll see you soon. Thanks. Bye.